All right, welcome to this case study where today we're unlocking financial freedom for a couple. They're in their late 30s and they want to retire before they're 55. All the names have been changed, but I want to show you what's actually possible when we start to get some focus and some purpose behind our money. And before we get started, this is general information only. If you're looking for a personalized strategy, then you should reach out to a professional, but everything that I'm going to go through today is not specific to your individual circumstances. So we had a couple, they were 39 and 41. So we had a household income of just over 270,000. So one member of the couple was earning 120 and the other just over 150. They had a pretty healthy surplus, so around about $1,200 per week. Superannuations, one had 240 and the other had 170, and they had about $130,000 in the bank. It was currently sitting in their offset. So to paint a picture of where they were sort of sitting at the moment, they had a home which they just newly built, and they were then going to move into that and then keep their current home, their current residence, as an investment property. They also had superannuation and then that cash sitting in their offset. The key drivers for this couple were, what else can we be doing with our cash? They knew that they were accumulating on an ongoing basis, and they also had 130,000 just sitting in their offset. Now asking the question, is there something else that we can possibly be doing with this? They also really wanted to have options before they retire. So they didn't want to buy into the traditional model of hitting 60, 65, 70 and having a body that was run out. They wanted to travel. They wanted to be able to do things before they would actually stop having the ability to do so. So they wanted options, which was really important for them. They also saw their friends and peers doing some pretty smart things with their money and thinking, how are they actually doing that? And how can we do the same? And lastly, they also had kids. They wanted to understand, how do we actually set them up for the future? So what we're able to do in this planning session was look 16 years into the future and see that our projected net wealth at that stage would be over $4 million in nest egg assets. Additionally, that's made up of a home that was fully paid off. We were able to pay that off within a 10-year time frame, which one member of the couple was absolutely phenomenally pleased with. And then additionally, we're going to keep that investment property because it was a great quality property. It also had high quality land value. So we really wanted to hang on to that to then ultimately have options during that retirement. We were also able to build a diversified portfolio of high quality assets, jumping nearly close to that $800,000 mark. So really strong bases here. Now, the strategies we actually implemented here was get really smart with our debt management. So we're clearing our mortgage by making additional repayments. We're keeping that money inside the offset because that's going to ultimately provide a buffer and also gives us opportunities in the future if we did want to invest in other assets as well. So we get a lot of that freedom and flexibility by having that money there in the offset. And we're also going to structure the investment property as interest only. Strategy number 2 was to add a diversified portfolio. So what this means is we're going to go out there and buy high quality assets across multiple sectors, multiple industries, and have multi-managers looking over that money to make sure that we're spreading the risk, but also getting the majority of those gains. We're going to reinvest the dividends. So the compounding interest, as Einstein said, is the 8th wonder of the world. That's really going to start to grow and accumulate with time. And of course, to spread the risk even further, we're just going to dollar cost average into the market every single month. And the third major strategy was to optimize their superannuation. So right now they're in what's called accidental super. So you choose an employer, you start working for them, and you choose whoever they ultimately put you in with. Maybe it's the default fund. In this case, it was. And so most people don't know this, but when they choose the default fund, they also get a default asset allocation. It can include quite a few defensive-based assets and not as many growth-based assets as maybe is appropriate for the individual. So we got smart with the asset allocation for the stage of their lives that they're currently at. And again, we're going to buy high quality assets inside the superannuation environment. So now let me take you over and show you what it actually looks like. So here we've got the client, we've changed their names, and ultimately we're going to call this the scoreboard. So what we decided is that we wanted $80,000 to pay for life and $20,000 for the nice things, the holidays, the extra toys inside of that retirement. Now, this is per annum, and this is every single year without drawing down on that capital. Now, that means in today's dollars, we'd need 1.8 million because of the effects of inflation. We've got 16 years to go ahead and build that wealth. So our target is 2.67. Now, if we have 2.67 in nest egg assets, we're going to be able to create $100,000 forever in perpetuity. Now, with these strategies, we were able to absolutely smash that. So we got to the goal of just over that $4 million there. So how do we actually do it? Well, the first thing is I mentioned that we got intentional with our superannuation. And so what that means is ultimately there's a big difference here. And this is why it's so important when you're young to get your asset allocation and to get your superannuation intentional. In this case, they still wouldn't be able to access their superannuation in 16 years' time, but the difference here is between 932,500, we'll call it, and 1.6, well, 1.27, let's call it. The real difference here is the potential to create 422,000 more dollars in retirement, and they wouldn't even be able to access their superannuation at this stage. So the number would actually be higher. Now, another strategy that we implemented was to start making additional repayments on their home loan. So what was happening with this couple is they just built a home and they're actually on a construction loan. So that means you get interest only, and it's a lot smaller for the repayments whilst you're building your home. But in about a month's time, they're going to get the keys. It's very exciting, but that also means that they're now going to start to pay a regular sort of rate. So we actually did the calculations, moved that up to about 6.2, which is what we're sort of seeing for owner-occupier houses right now, which meant that we had to adjust the monthly repayments. Now, along with that monthly repayment, we then took the difference and took that off their surplus. So I mentioned before that their weekly surplus was around $1,200. The difference now is around about $950 to play with now and go out there and buy high quality assets. So what we did is we just put a large majority, so we put 559 of those dollars every single week into and off the home loan. So it takes their mortgage home loan repayments from 4,420 to nearly 7,000, so 6,842. Now, the good thing about this is actually we're just going to park it inside an offset account. So if we really, really needed the funds, they're going to be there. But also, by utilizing this strategy, as well as parking the $130,000 inside of the offset, we're actually able to see that home paid off under 10 years. So rather than the traditional 30-year time period, we're able to really skyrocket that and slash it into essentially slash off 2/3 of the time of what that looks like. Then the beauty of that is we can then use the additional money that was going to the home loan and actually invest in other high quality assets. And so in this case, that's exactly what we did. We put it into a portfolio. We also decided that we wanted to build some wealth outside of super and outside of the family home. So what we did is we just created a portfolio. Very conservatively, we were putting in $1,000 a month into a highly diversified portfolio. So in this case, we'll buy an index fund. And so we're going to have low fees, but also have high diversification. By utilizing this strategy, we're able to buy a little slither of the best companies around Australia and around the world. So we benefit from high diversification. So if one company is going down, the others are going. It's been proven time and time again that this particular strategy outperforms by far trying to pick and choose individual assets, as well as it helps you sleep way better at night because you're not worried about an individual company going down with all your eggs in one particular basket. What this means for this couple was it was going to create over nearly $389,000 of a diversified portfolio over that time period. Now, once that home loan's paid off, we're also going to put that into that same portfolio, which ultimately ends up being over $780,000 worth of assets there. Now, the wealth created through this plan is going to be just over $1.2 million. And then ultimately they're going to end up with $4 million as a nest egg. So we absolutely smash the projected net wealth. Now, what that means, it gives a couple of options. The first option or first lever that we can pull on is we can actually pull back the time to actually retire. So we want this number down here, the 4060. As long as that exceeds this number up here, 2672, we'll actually be financially free and be able to draw out over $100,000 in income. So even if we move this back to 12 years and slash 4 years off their retirement, you can see here this is now sitting at 2.4 and this is still above it. So we actually have options inside of retirement. So this couple was really happy with this plan. Not only did it create options in the future to be able to help out with their family, but it also meant that they were diversifying their assets, they're keeping their home, they're becoming mortgage free, and they're also building out a really great share portfolio. So hitting it from multiple angles. So this is one of our free wealth potential sessions that we run with all new clients who are looking to come on board. And it gives you ultimate clarity into where you are, where you would like to be, and lets you see what kind of strategies may work for you to bridge that gap between the two. If you'd like to claim your free wealth potential session today, you can click the link below and book in a time to have a chat with us. So you can ultimately see where you can end up with a smart financial planning.